And on today's show, the fixed and multi-year guaranteed annuities, part one of this week's series on the Final Four product review with nationally recognized annuity expert Mike McGlothlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmouth. Let's get down to business. Well, welcome to the show, Mike.
It's great to be back.
Always love to have you back. And now we're talking about the Final Four. You know, basketball's on now, brackets are happening. We're heading down for the Final Four people. Hopefully somebody from my conference gets in for a change. But I'm looking at annuities now. Today we're going to look at fixed annuities and MYGAs. Now walk us through, we're looking at a spreadsheet here, and walk us through what we need to know. Here are the current rates, and really, I'm sorry, but I'm kind of like most consumers and most agents. I gravitate to 3.2%, 3.85%.
Sure.
Walk me through why I need to really look at this a lot harder than that.
Sure. What we try to get a person to look at are the effective rates here, and that takes into consideration maybe the first year bonus and then what the renewal rates would be on a fixed annuity. And I think what's really important is when you're taking a look at reset type of annuities like this product from Reliance Standard, is what are those renewal rate histories? Because that's where the really proof is in the pudding.
Do these publish those renewal rates? Do most of these carriers do that?
Most of the carriers do publish them, and you can ask your person to publish those, and we'll send you a spreadsheet of all those back for as long as the product has been available.
So we can look at the history to see how honest they've been. Well, when we're looking at fixed interest rates and MYGA rates, they're still relatively low, but much higher than CDs. So when we compare it to anything that's certificate of deposit, I mean, at bankrate.com, it still looks like we're about 175, 180 points above the line, right at about 5 years.
Yeah, absolutely. We've been that way for several months now. Even when we had a spike in interest rates in December, we still maintained that spread of about 160 to 180 basis points.
When I'm looking at a spreadsheet like this is a really good informational grid, really helps you understand and distill down. Can you imagine in the old days, we actually had to sort through specimen policies to find all this.
Yeah.
But now walk us through, what do I need to know? We know the current rates, and that's where, I'm sorry, my eyes gravitated, but then you corrected me. Here's the actual effective rate, which I think is really a good idea. What about surrender charges? And talk about that in light of MYGA rates, because that's what's really affected.
Yeah, absolutely. You take a look at some just pure 5-year type of products versus 6-year, and what is that difference in rate? Maybe just 5 basis points here for going out one particular year. So it really doesn't seem very attractive to tie up your money for 12 additional months just to get 5 extra basis points. So we take a close look at that. However, then you start taking a look at maybe some other opportunities here with integrity to go out a little bit longer and then have a little bit of higher rates. But also the other thing that this allows you to do is when interest rates go up, you can re-lock in without any type of surrender penalties.
Well, now we're looking at a lot of these here. We have Reliance Standard, American Equity, we have Genworth, and then of course we have Integrity. I'm looking at some of these different ideas. In the fixed rate market, if a person doesn't want to do the MYGA rates, what are we looking at really in our rate of return? What's our best out there? I'd say A- rated and above.
For a true fixed annuity?
A true fixed.
I would point everyone to Reliance Standard here with a first year rate of 3.2. Or you take a look, well actually let's just go right through here with a rate of 3.2 and then a renewal rate of 2.2. And then again, they have really been spot on in terms of their renewal rates, of being very consistent and treating the policyholder really well over the course of time.
Now we've noticed that consumers are still selecting, I would say probably because of advisors giving them recommendations, we're still looking at interest rates of 5 years because everybody's anticipating kind of interest rates increasing. The Fed's now already kind of tipped us off that the tapering is going to slow down. So when I'm looking at this, does MYGA come into play if I know that interest rates are going to be going up?
Well, I think that MYGA does, because who knows whether interest rates are really going to go up. And a lot of client behavior is, I can get 2.35 guaranteed, and rates aren't going to go up that much in that short a period of time to make up that difference. Especially if I'm in a CD right now earning 85 basis points, I'm capturing 180 basis points above my CD for the next couple of years. Those interest rates have to go way out of the roof for me not to lose on that 5-year MYGA.
Are most of these interest rate and MYGA annuities, are they qualified and non-qualified?
Yes, for the most part. You could use them both in an IRA. And that's where a lot of clients are starting to look at some of the IRAs. They've had good runs in the stock market, and now they're saying, you know what, I'm 55, 60 years old. I want to take some money off the table. And so they'll shift some of their money into a fixed annuity. The other thing that we're seeing a lot of, Steve, is where people have about 25, 30% of their money in bond funds. They're shifting those bond allocations over to fixed annuities. We can get similar rates to a 10-year treasury, but the key thing is if you maintain your position in a bond portfolio and rates go up by 1%, you could see as much as a 10% depletion in the value. So a lot of clients are taking that off the table right now.
An interesting thing that we're going to talk about in the second segment is we have some additional features that could be living benefits attached to some of these annuities. We come back from the break, we're going to say not only are the rates better than most CDs, but now we're looking at ancillary benefits that you could have, and some of this is at no cost. We'll be right back. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back, Mike. We're talking about guaranteed interest and MYGA annuities, and we kind of feel like the Fed may be looking to raise rates. We've talked about that. Now, we also said surrender charges. You know, the longer the surrender charge, right, there's a lot of protectionist issues. Just to make sure that everybody understands, part of that is to protect against disintermediation. They don't want to have any problems there. And of course, there's compensation issues that we have to protect as well.
Certainly.
Okay. Yeah. Now, once I get past that, I'm interested in these ancillary features. Walk me through the grid on down here on some of the carriers here and what they add on besides the rate.
Yeah, absolutely. The key thing here is liquidity. If you're locked into a 5-year CD, if you go and surrender that CD, you're probably going to forego 1 year's worth of interest, and that may or may not eat into some of your principal. With most of these annuities, you have at least a 10% free withdrawal, and some of them are happening immediately, some of them after 30 days. But in the case where we have the highest first-year rate, you have to wait for the first year before you have 10% free withdrawal.
Let's make sure
so that's a key thing.
Let's talk about that because that's a huge issue. We're talking about reliance, 10%. If I had to come, we're looking at instant liquidity of at least 10%. This is 30 days, right? When we're looking at standard, and then when we're coming back at the higher rate here, and I'm looking at American Equity, you'd have to hold for a year. Now, most people who are going to lock down for 5 years pretty much probably can hold for a year. So that's pretty, but I like the liquidity issues. How big is this against other issues like liquidity of funds, liquidity of CDs? Is it pretty much a par or is there a little advantage here?
No, I think there is a little bit of advantage because when you take a look at pricing risk of funds and things like that, if you have an emergency, that's where you're going to get into some of these at 10%. You have something that's happened where you need to dip into principal. It's probably your last option of what you want to use. If the market's down 20%, then you're buying up far more shares than what you were if you were at par value. So this is a great opportunity to get into some emergency cash. The other thing here is also take a look at some of the nursing home confinements. Some of these products have the availability for no surrender charges if the client goes into a nursing home facility or has a confinement. When you're talking about a lot of different things that can happen over a 5 or 10-year period, that's something that, you know, inflation, health, taxes, those are things that we have to be mindful of.
Any cost to have these kind of ancillary benefits?
The cost, Steve, is the fact that one interest rate may be more or less than the other. But when you start looking at interest rates and say, instead of just coming in and saying, I've got to get the best return for my client, we want to take a look at the best solution. And that best solution might have some liquidity. If they don't have liquid net worth, in case that they have a medical emergency, that ought to be something that
so if I don't have an annuity with an LTC linked benefit, I don't have a standalone long-term care for extended care coverage, this could be an alternative to get to my money without any surrender charge.
Absolutely.
Now, this is pretty good liquidity. I mean, most seniors are going to look at this and say, for the difference, a nickel, or actually less than that, 0.5 basis points, that's a pretty good deal to have that kind of liquidity. When you look at this, how many clients have you seen over the years? Because you've been in this business a long time. People tapping this?
A lot of people tap into the 10% free withdrawal. We don't see a lot of people use the nursing home, but it's a what if. You know, what happens in what ifs? What we do see a lot of people do is start looking at how do I exit out of this in terms of deaccumulating. How do I provide an income? Look at this one from Integrity. One nice option here is that it allows partial annuitization, whereas some of these others, you would have to annuitize the entire contract. So this provides you a little bit more flexibility. Maybe you only need $500 a month, then you only have to annuitize that amount that generates that $500 a month.
And you can keep the rest.
And you can keep the
and
rest.
that stays on the normal surrender platform, that's normal period?
Absolutely. Plus you divide up your cost basis appropriately so that you maintain your cost basis in the existing contract and take that certain portion of the cost basis to get tax-free income.
So they're allowing basis to go with this as well?
Absolutely.
Wow, I think that's a huge, that could be a huge liquidity benefit.
Yes.
Now, when you're comparing interest rates and MYGA rates and some of the benefits and these ancillary liquidity benefits, what happens when the Fed, if they ever do it, I know we've been saying this for years, but they're, sooner or later they're going to have to start raising rates, I would think, and those numbers are going to jump. Now, I don't know how far, how fast, but right now we can start to see there's little upticks, there's still a little movement going on right now in the treasuries. Is 10-year treasuries are really our benchmark here?
10-year treasury has been the benchmark for the insurance industry for years and will continue to be so.
So here are some of the carriers that we're talking about. Again, American Equity, Reliance Standard, Genworth, and Integrity. Some of these are some of the top 4 carriers that we're looking at. Again, A- and above. And these are the carriers we're kind of looking to, not only for fixed, but MYGA rates with some ancillary liquidity options that are given here. And I think they're really huge for the client. Well, that's our show for today. Remember, before moving forward with any of the ideas, always consult your tax advisor, legal counsel, or your broker-dealer compliance department. Missed an episode? You can go out and view any of our past episodes at downtobusiness.brokerage.com. And remember, you could be wiser as an Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.